Hi, welcome to Trading with TK, teaching you to turn ideas into money. We're at www.tradingwithtk.com, and today is our weekend question and answer period. This is where some of my readers write in questions, and I try to answer them. So let's get started. First question comes in from Mark, and Mark writes, "Great blog, I'm loving your picks. Thanks for doing this. I had a question for you for your weekend question and answer. In my observation, the first few days of the beginning of the month tend to have an upward bias. Do you notice the same thing? If so, what do you attribute it to?" Well, Mark, you're very observant because under normal conditions, yes, the first couple of days does have an upward bias in the market, and there is a reason for that. Because people who subscribe to these predestined plans where they have so much money taken out of their paycheck every month, whether it be 50 or 500 or 5,000, that money becomes available to their fund managers on the first of the month, and they automatically, every first, second day of the month, boom, in the money comes. There's no thinking about it. There's no. They already have their own portfolio that they're just adding to. It could be an index fund. It could be all kinds of different funds. But as soon as they get the money, they put it in the market. Now, it's a good question about funds because the thing about funds is, when you fill out the form, they say, do you want high risk or low risk, or high growth, low growth, or safety or risky? What you really want is you want to know who the manager of the fund is, because it all depends on him. Back in the late 70s, early 80s, there was a guy named Peter Lynch. I'm sure people have heard of him. He was the manager of the Fidelity Fund, huge fund, biggest at the time. And his returns were so far above every other money manager that he put everybody to shame. He was a simple guy with his approach. He invested in what he knew, and he was just a very bright guy when it came to investing. Now, there are guys like him around, and the trick is to find them and what fund they're managing, and that's where you want to put your money. So the next time they give you a form to fill out, whether you want high growth, low growth, high risk, low risk, you should say, who's running this fund, and show me what his track record is, and then I'll decide what I want. And a lot of times you'll find these good managers and smart guys, and then they'll leave the fund, and the fund doesn't even tell you. So you think he's still there, and he's not. The trick is to follow him around, find out who these good guys are. I don't know exactly how to do that, but I think if you did some research, you might come up with a way. Okay, Mark, I hope that answers your question as to why the market always seems to have a few upticks the first couple of days. It's because it's all that fresh money coming in that gets reinvested at the beginning of every month. Okay, so next question comes from Alex. This is an international question. I like these international letters because it just shows you how flat the world is, especially when it comes to this game. Okay, Alex writes, I'd like to get an explanation about bubbles and when to buy into them and when to avoid them. Excellent question. But the time to buy into them is the beginning of them, and the time to avoid them is when they're over. But the truth of the matter is that bubbles come along so seldom that if you sat around looking for the bubble, you wouldn't make any money. The most famous bubble we have in America was the dot-com bubble back in the late 90s and early 2000s. If you go back and look at all the charts, you'll see how fast and furious they went up. They went up so far and so fast that they almost looked like they were going to fall over on top of themselves. All bubbles end in disasters, though. And the most famous of all bubbles is the tulip bubble back in the 17th century. So you should Google that, tulip bulb mania, and there's a number of stories about it, and it explains the mob mentality, which is what's really controlling these bubbles. It's just a mob out of control, and these bubbles always end in disaster. So we don't try to do that here at Trading with TK. I try to pick stocks that look like they're getting ready to make a run of maybe 20-25%, and we try to catch that part of the move, and then we're out of it, and then we're on to looking for the next move, and hopefully all those will add up, and we'll have a nice return at the end of the year. If I sat around looking for a bubble to develop, I wouldn't I wouldn't have anything to do, because you never really know when the bubble is starting either. So Alex, I hope that answers your question. And my next question comes in from Jay from Maryland. Jay says, I have a question for the weekend. I've noticed that you referred to the average volume to make sure that there's enough liquidity in your stock picks, but I haven't seen you include recent volume changes as a factor in why you pick these stocks. Okay, good question. Volume is an indicator, but it's only one little indicator. And my take on volume is the stock has to trade at least 400,000 shares a day or more. There needs to be liquidity so that if you change your mind and you want to get out and you want to sell, you don't have the market say to you, to who? There's got to be enough liquidity so that you can hit a bid down a penny or two and get out. As far as the volume on a daily basis, yes, it's nice to see high volume pushing these stocks up, and then when they pull back down, it's low volume. But if that doesn't happen, it's not a deal breaker for me. In other words, if I buy a stock at 5 and my target is 7.5, and it gets there, but it gets there on light volume, I don't care. So not having the volume there isn't going to make me change my mind. So yes, it's a key. It's an indicator, but it's not that important of an indicator to me. I think I like a lot of technicians make a lot more to volume than really is that important. As long as there's enough volume to support your position, you'll be fine. Okay, I hope that answers your question. And speaking of indicators, I mentioned on my blog the short-term indicator that I speak about a lot. It is proprietary. I've developed it myself. But remember, it's just a short-term indicator. It's something that might last anywhere from a couple of hours to a couple of days. And it's just something that tells you when things get overdone and need to come back down. Because the market, it's like a runner running a race. He has to blow out and he has to breathe in. And this indicator shows you when he's almost out of breath, when he needs to pull some air back in. And that's pretty much what the indicator is about. If you want to know more about it, you'll have to go to YouTube and dig up one of my past videos on indicators. And if you watch that, that might answer some more of your questions. So I think that's it for the weekend question and answer period. I hope I answered your questions. You can start sending some new questions in for next weekend. Hopefully that the questions you ask me aren't just about your particular situation, but that you think the entire community might benefit from. So until Monday, this is TK signing off.